Are we headed for a bear market? And what exactly does that mean? Today's video, we're going to be looking at a story that came out in the LA Times. What could it really mean if we're looking at a bear market, and what is the reason behind it? Now, Wall Street seems like it could be entering into the bear market. Now, that means that we are seeing a 20% dip or 20% decline from an all-time high that we've seen. Last bear market happened in 2022. If you remember, buy the dip was a very common phrase that we use, but dollar cost averaging is the smart way to do it. I don't wait for a perfect exit point, for a perfect entry point to get in and out of the market. I dollar cost average into all of it. Now, when we start looking back in 2022, the decline feels like it's a lot more sudden now than what we've seen before. Once the benchmark S&P 500 tumbled 34% in 1 month. If you remember, everyone was doing exactly what they are now, kind of panic selling. So why do we call it a bear market? Now, this again, when you look at something like the Dow Jones Industrial Average fallen more than 20% off a recent high, that is when it is concluded, or officially when the market closes, that is called a bear market. Why use a bear to refer to a market slump? Now, this is something new that I absolutely had to know. Bears hibernate, so it represents the stock market retreating or going into a hibernation when it does the decline. Now, the S&P, or the main barometer of health, was down 1.1% Monday and is now down 18.4%. So remember, the target that we're seeing is 20% for that bear market. We are at 18.4 as it sits right now. Today, it was literally almost just break even. So again, kind of teetering way on that bear market. So what is really bothering investors? Now, we've talked about this. When you look at the tariffs, when you look at the trade wars, it seems like it's ratcheting up a lot quicker than people thought. Trump did follow through with declaring those 10% baseline tariffs and taxes on imports from all countries and higher tariff rates on dozens of nations that run trade surpluses against the United States. Now, I'm not going to go into a ton of detail exactly what it is. Do some Google research, figure it out. But when you start looking at global markets, so you think it's getting bad within the United States, being down that 18.4%, we have seen a massive sell-off in China, and it is affecting the global economy. And they said in here, a massive sell-off across a lot of different countries have cratered their economy, and there's even talk of possibility of seeing some smaller nations, even their economy itself just collapse because goods and services are going to be more expensive. So what exactly is a tariff? When we think about this, tariffs cause economic pain in the part because they are taxes paid by importers that often get passed along to the consumers, which adds to the inflationary pressure. This means that we could see a reduction, and I know we went to possibly seeing 3 or 4 rate reductions within 2025 itself. They also provoke trade partners in retaliation, which is what we're seeing, which can hurt all of the economics or all of the countries that are actually involved. Now, this can also be complicated decisions on businesses, where they're going to grow, where they're going to invest their money, which suppliers they're using, which countries we're going to get products from. There are so many different things that can affect the tariffs. But the real question on a lot of people's mind is, if we do enter a bear market, how long do they last? How deep could we go? Now, we've seen through history, now since World War II, the average has been 13 months from the peak to the trough, 27 months to get back to a break-even point. So if you think about that timeline, it could be roughly 2 to 3 years that we see this economic downturn. S&P 500 index has fallen on average 33% during bear markets. So think about that. We're at 18.4% right now. Everybody is freaking out, selling, getting out of the market, moving it to bonds, doing all kinds of stuff. We seen the average of a bear market at 33% at the pullback. Imagine again, we go down another, what is that, 15% within there. Now, the biggest decline, of course, since 1945 occurred in 2007-2008 bear market, which we know was the housing market. Fundamentally, we were doing some messed up stuff with the housing market, not requiring people to provide proof of income, and a lot of crazy things that really led to that. S&P 500 fell by 57%. Now, guys, again, put it in perspective. We're at an 18% decline because of the thought and the fear of tariffs, when the S&P 500 fell 57% in 2007 to 2009. That is a massive decline that we've seen right there. Now, history shows that the faster the index enters the bear market, the shallower the index or the fall will be. Historically, stocks have taken 251 days or 8.3 months to fall into a bear market when the S&P 500 has fallen 20% or faster. Index averaged around 28%. Longest bear market lasted 61 months, which was in 1942. So it was going on 80 years ago, cutting the index value by 60%. Again, we're at 18.4%. It fell by 60% in 1942. So when officially does this bear market end? Generally, investors look for a 20% gain off of the low point. So if we're pulling down 18.4, if we go below that 20% mark, then the rebound has to be 20% greater, almost putting us at kind of an even and sustain that growth for at least 6 months, having the 20% plus. Now, looking at what we just seen, 3 weeks for stocks rise in 20% in 2020, which we know was the really big thing when it came to COVID and everything that was kind of the global pandemic. So should you sell now? This is a question that I get from everyone, and I'm getting it all the time. If you need the money or want to lock in all of those losses, absolutely go ahead and sell. The question becomes, where is your re-entry point? If you're at an 18.4% loss, you sell at that 18.4%, you are locking in all of your losses. One could be beneficial if the market continues to decline, but if the market does make some sort of rebound, you're going to miss all of those and you're going to be buying it, not at the very, very low point. You're going to start buying it when it goes up, because chances are timing the market for a majority of us, including myself, is near impossible. But now when we think of this, bigger financial houses, bigger advisors say, ride the ups and downs. Remember, when we start looking at investment strategies and knowing exactly what your strategy is, 5+ years is an investment strategy. If you go back looking at the performance of the S&P 500 over the last 5 years, it has done incredibly well. Never, and you do not want to start dumping stocks when the stock market is bleeding. It also prevents any gains when you see the rebounds or when you see the level out. Many of the best days in the stock market, in looking back again, historically, have been right after or during a bear market or when a bear market just ended. The two separate days when we see in middle of 2007, 2009, when the S&P 500 increased 11% in one day, as well as leaps of better of 9% a couple times kind of along the market among the bear market that we've seen. And we know that we could see it again. So is it really worth it to pull your money? In my opinion, guys, if you've written it down, if you've wrote it down this far, I would just stay in it. I am staying in it. Like I said, for me, right now, thinking of that 18.4% decline, that means I am buying everything at almost a 20% discount, which I did today. Most of you know my portfolio. Most of you have seen exactly how I do purchase into the market. We buy into the market every single Monday morning, both with my dollar cost averaging going into the QQQM, the S&P 500, and then the HD. The other portfolio that buys every single Monday morning is actually going into 0-day covered calls, which we know have taken a very big hit, but still producing and generating a lot of income. Right now, for what we have invested in those, we're seeing about a $450 return every single week with what we have invested. Now, of course, the principal did go down quite a bit, but again, with the reinvestment of those dividends we're seeing every single week, we are buying it at a very big and very high discounted price, which means that we're going to have a lot more when we do see the rebound, because we've been stockpiling it through this whole down market. All right, guys, so that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.